Remember, in 1980, the Fed funds rate was 20. And I had a loan outstanding from a bank at 22 and a quarter. 40 years later, the Fed funds rate was 0, and I had a loan outstanding from a bank at 2 and a quarter. So the decline of interest rates by 20 percentage points over that period was a dominant factor in the financial world. I think it was the most important single event in the financial world in the last 50 years.
In the current financial landscape, a significant shift is occurring. For the past 40 years, the world has witnessed a consistent decline in interest rates, creating an environment of easy money and booming investments. However, we are going through a sea change, which is a complete transformation, a radical change of direction. One of the biggest person in finance and economics, Howard Marks, says that we are moving away from the era of easy money and emphasizes the importance of recognizing this sea change and adjusting investment portfolios accordingly. So what is this sea change? And how should we invest now compared to the last 40 years?
In the period 09 through 13, the Fed took the Fed funds rate to 0 to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal ranges. So we had a low interest rate environment, which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. And if you read articles about, for example, Silicon Valley Bank, they talk about the easy money environment. And the main point of sea change is we're no longer in an easy money environment.
As interest rates fell, the allure of the stock market grew stronger. Investments in bonds and fixed income securities, once the bedrock of conservative portfolios, were now being overshadowed by the lucrative returns of the stock market. But as all things must change, so too did the financial landscape. Interest rates, which had been a tailwind for investors, began to rise. This signaled the end of an era and the beginning of a new, uncertain financial future.
We're going to see rising rates.
Rising interest rates that will make the cost of borrowing go up.
Today's data shows many Americans are beginning to really feel the ripple effect of the Fed's interest rate hikes over the past year and a half.
Now, while consumers are still spending, they're getting a lot less for their money. Surely you all know this. At the same time, the cost of carrying loans and credit card balances, that has grown even more expensive.
The rising interest rates brought a ripple effect across the economy. Businesses accustomed to cheap borrowing costs now faced a harsher reality. The easy money era was fading, and a new challenge was emerging.
You found a company to buy, you went to the bank, they said, we'll lend you $800 million at 5%. Now the loan is up for renewal, you go in, they say, fine, we'll lend you $500 million at 8%. So you have less money and your cost of capital is higher, and you have a $300 million hole that you can't fill.
In this new financial epoch, the strategies that once yielded great returns are no longer as effective. Investors and financial experts are now navigating uncharted waters, seeking new opportunities in a landscape altered by rising interest rates.
You know, the S&P has returned, S&P 500 stock index has returned 10% a year plus, just a little over 10, for 100 years. That was enough to turn $1 in 1920 into $15,000. That's a good rate of return. Today, you can get equity-type returns from what we call credit instruments, loans, corporate loans, loans for buyouts. You can get high single digits on high-yield bonds and leveraged loans, public instruments that are tradable and liquid, or low double digits on private loans for buyouts. The best buyouts, the biggest buyouts, double-digit returns. Isn't that enough? And loans on credit instruments, returns on credit instruments are much safer than equity. Equity just gets the residual. After everybody gets paid, they get what's left. Credit gets paid early in the process, and if people don't pay you, you get the company because they go bankrupt. So it's quite safe, and and returns that are fully competitive with equities with a good level of safety.
As we stand at the threshold of this financial sea change, it's crucial for individuals and businesses alike to understand and adapt. The future may hold uncertainties, but with knowledge and adaptability, there lies a path to continued prosperity. Knowing this financial event is crucial, but do you know the exact steps to take to ensure you are ahead of the competition? Like and subscribe for more, and in my upcoming videos, I will help you stay informed of any crucial financial knowledge.